A very good evening to all of you and welcome to another edition of WealthWise with Edelweiss, our webinar series on personal finance with industry experts. Joining us today is Pranjal Kamra, the CEO of Finology Ventures Pvt Limited, a fintech startup that provides industry certified courses on finance and law. Pranjal is also a YouTuber with over 13.5 lakh subscribers. The topic for today is how to create a winning equity portfolio in these volatile markets. Please note that there might be a time lag of 10 to 15 seconds due to network or connectivity issues. Kindly bear with us. Welcome, Pranjal. Over to you.
Hello, Anga. Thank you so much for having me here. I mean, it's an honor, and I'm super excited to share whatever insights I have with all those who are attending this webinar. Firstly, I would like to warn the viewers that internet on my side is a little weak, so I might get disconnected or there might be a lag. So I really apologize in advance for that. And with this disclaimer, let's begin with today's topic. So, I am sure that when such volatility happens in the market, everyone is confused regarding which stocks to stay in, which to buy, which to sell. Because, what has happened is that till a couple of months ago, stocks that were considered deep quality and, crash proof have suddenly halved in value. So this causes a lot of confusion in the minds of the common investor that where is safety? The problem today is that, everyone is struggling to find safety with gold already having ran up to a huge extent, with interest rates in FDs and saving accounts at an all-time low. You just don't know where to go. So this is why it's imperative that today we discuss that which sectors in the market are comparatively safe, which industries, which companies, which sectors you should prefer, and which sectors to totally avoid, and then how to mix it all up to have and then how to mix that all up and end up with a well balanced portfolio that will set you on the path of growth for the next couple of years. So, I'll start with what was happening before this COVID came into picture. One thing that was clearly happening was that there was a quality bubble. Everyone was running after quality. There were some quality stocks which were trading at a PE of 80, 90, 100, sometimes more. So there was clearly a bubble. And now a lot of these stocks have corrected substantially, 30, 40, 50%. So one thing is clear that that the high valuations that some of these quality stocks enjoyed were due to a bubble, and those valuations are certainly not going to return. So you will not see those stocks again trading at those sky high valuations for a considerable period of time. And secondly, India was big on rising disposable income. So everyone was very bullish on these consumption stocks, say entertainment stocks, airline stocks, white goods, things like that. Because everyone believed in India, disposable income is rising very quickly and will continue to be so. So this trend will also take a while now. This trend will stop. Rising disposable income will now take a couple of years to recover from here and be on the same growth path. So those white goods stocks, those luxury good stocks will have to take a breather. Now let's move on to what's happening. I see a lot of retail money now chasing blindly a lot of pharma stocks. Now there's a big problem here. See, pharma stocks were definitely, most of the pharma stocks were undervalued in the last couple of years, last 3 years due to the US FDA problem. So now there's this double opportunity in the eyes of a common investor that one, the valuations are cheap, and second, everyone is buying pharma stocks and pharma consumption will rise because of COVID. And here is an eye opener that in general, I believe that pharma consumption, pharma sales is not going to rise just because COVID happened. Because, see, there are a lot of pockets in the pharma sector. There's this derma pocket that deals with skin and hair problems. Now, those consumption of those medicines, those OTC drugs is not going to rise. A person is unlikely to visit a dermatologist for certain minor skin problems. This won't happen. ऑल्सो बहुत सारे और ऐसे फार्मा में प्रॉब्लम्स होते हैं, जैसे एक हो गया वेलनेस, वेट मैनेजमेंट, न्यूट्रिशन। ऐसा भी नहीं होने वाला है कि ये स्टॉक्स एकदम कि इन ये मेडिसिन, वेलनेस हो, न्यूट्रिशन हो, वेट लॉस हो, ये अभी इसका कंजम्पशन बढ़ने वाला है, इसका कंजम्पशन भी कम होगा। सेकेंडली, अगर हम देखें तो अगर हम लॉकडाउन में हैं तो टोटल ह्यूमन टू ह्यूमन इंटरेक्शन कम हुआ है, यानी बहुत सारी ऐसी कम्युनिकेबल डिजीजेस जो पहले हो जाती थी वो अब नहीं होंगी, क्योंकि हम सर्दी खांसी, इन्फ्लुएंजा, निमोनिया होगा ही कैसे, हम लोगों से मिल ही नहीं रहे। तो बहुत सारी ऐसी डिजीजेस जो ह्यूमन इंटरेक्शन से होती थी कोविड के साथ साथ वो भी कम होंगी, तो उनका ट्रीटमेंट वाली जो मेडिसिन है उसका कंजप्शन भी कम होगा। बहुत ज्यादा इंडिया में रोड एक्सीडेंट्स बहुत होते थे, उसकी वजह से हॉस्पिटलाइजेशंस बहुत होते थे। एयर क्वालिटी इज क्लीनर, एक्सीडेंट्स नहीं हो सकते, एयर क्वालिटी इज क्लीनर। तो ये वो कुछ अच्छी चीजें हैं जो कोविड की वजह से हुई, लेकिन इसके कारण कुछ फार्मा कंपनीज को प्रॉब्लम आने वाला है। तो ओवरऑल अगर मैं देखूं कि क्या ओवरऑल इंडिया में 2 महीने पहले लोग ज्यादा दवाइयां खा रहे थे या आज ज्यादा दवाइयां खा रहे हैं, द आंसर इज क्लियर कि 2 महीने पहले ज्यादा दवाइयां खा रहे थे। तो फार्मा सेल्स रातों रात डबल हो जाएगी ऐसा बिल्कुल नहीं होने वाला है। तो वैल्यू है ठीक है, लेकिन 3-4 फार्मा स्टॉक्स के अलावा अभी जो हर फार्मा स्टॉक भाग रहा है, और रिटेल इन्वेस्टर्स कुछ तो इंडेक्स, फार्मा इंडेक्स में भी पैसा लगा रहे हैं, ये बहुत रिस्की है और ब्लाइंडली फार्मा स्टॉक्स को चेज नहीं करना चाहिए। इसके अलावा अब हम कुछ और चीजें डिस्कस करते हैं कि कौन से और ऐसे सेक्टर्स हैं जो हमको अवॉइड करने चाहिए। एक क्लियर सेक्टर जिसमें चेंज आने वाला है वो है कमर्शियल रियल एस्टेट। हाँ, ये सुन रहे हैं कि बहुत ज्यादा वर्क फ्रॉम होम होने वाला है। इसमें अगर हम एक सिंपल सी चीज देखें कि क्या 5% या 10% लोग, ज्यादा नहीं, सिर्फ 5 या 10% लोग क्या वर्क फ्रॉम होम करेंगे? मुझे ऐसा लगता है कि हाँ, 5% ऐसी पॉपुलेशन तो होगी जो पहले ऑफिस जाती थी और अब वर्क फ्रॉम होम करेगी। तो ये 5% जो वर्क फ्रॉम होम पे शिफ्ट हो रहे हैं, दिस इज इनफ कि कमर्शियल रियल एस्टेट की वायबिलिटी को काफी नुकसान पहुंचाए। कमर्शियल रियल एस्टेट में जो ग्रोथ थी वो रुकेगी इसकी वजह से। तो वो स्टॉक्स जो कमर्शियल रियल एस्टेट पे डिपेंड करते हैं, प्रॉब्लम है। इसके अलावा एनबीएफसीज, मोस्ट ऑफ द एनबीएफसीज जिनकी क्वालिटी उतनी अच्छी नहीं है, जिनके पास लिक्विडिटी अच्छी नहीं है, जिनकी कैपिटल एडिक्वेसी अच्छी नहीं है, प्रॉब्लम होने वाली है। तो मोस्ट 80-90% ऑफ द एनबीएफसीज, उनसे भी अभी दूर रहना बेटर होगा। होटल्स हो गए, होटल्स अगेन एक ऐसा सेक्टर है जहां प्रॉब्लम होने वाली है। इसके अलावा मुझे एविएशन में ये प्रॉब्लम दिखती है कि अभी मैं देखता था कि बहुत सारा जो मेजॉरिटी बिजनेस ट्रैवल था वो कई बार सिर्फ एक मीटिंग के लिए, आधे घंटे की, एक कोई एकदम अर्जेंट मीटिंग नहीं, लेकिन चलो चले जाते हैं। तो कोई दिल्ली से मुंबई आधे घंटे की एक मीटिंग के लिए चला जाता था, ऑल्दो दैट मीटिंग वाज नॉट एब्सोल्युटली क्रिटिकल, लेकिन आदत थी। लोग कॉर्पोरेट्स के, ट्रैवल एजेंट्स के साथ, एयरलाइंस के साथ अच्छे रिलेशंस थे, बिग डिस्काउंट्स मिलते थे और लोग चले जाते थे। अब परमानेंटली हो सकता है ये हैबिट चेंज आए कि बहुत हद तक इस तरह के ट्रैवल को कॉर्पोरेट्स अवॉइड करें। तो जब सब कुछ नॉर्मल हो भी जाएगा तो ओवरऑल जो एयर ट्रैफिक है उसमें जो बिजनेस ट्रैवल का परसेंटेज था वो कुछ हद तक कम तो होने वाला है। तो ओवरऑल इस हैबिट चेंज के कारण मुझे ऐसा लगता है कि एविएशन स्टॉक्स को भी लॉन्ग टर्म फर्क पड़ने वाला है। तो ये तो कुछ बिल्कुल क्लियर साइंस है कि क्या स्टॉक्स आपको अवॉइड करने हैं, कैसे फार्मा स्टॉक्स के पीछे ब्लाइंडली नहीं भागना है। ये कुछ बहुत क्लियर ट्रेंड्स मुझे दिख रहे हैं। अब इसके अलावा अगर आप इन पॉकेट्स को छोड़ दें तो लगभग बाकी सारे पॉकेट्स में 6 महीने बाद, 9 महीने बाद, साल भर बाद, जैसे जैसे कोविड के इंस्टेंसेस कम होते हैं, रिकवरी आएगी। इन अगर मैं देखूं तो नॉर्मली चांस ये है कि साल भर के बाद ऑलमोस्ट एवरी इंडस्ट्री अपार्ट फ्रॉम द वन साइड डिस्कस्ड विल हैव अ नॉर्मल ग्रोथ आउटलुक। तो ऐसे में हाउ शुड यू प्लान फॉर दोज सेक्टर्स, हाउ शुड यू प्लान फॉर दोज स्टॉक्स? एफएमसीजी हो गया, आईटी हो गया, डिजिटल कंजम्पशन वाले स्टॉक्स हो गए, कपड़े, क्लोथिंग, इस तरह के जितने सेक्टर्स हैं इनमें नॉर्मल ग्रोथ आने वाली है। तो पहली चीज दैट यू हैव टू कीप इन माइंड इज दैट यू नीड टू स्टे अवे फ्रॉम लीवरेज। एनी कंपनी दैट कैन नॉट सर्विस इट्स डेट विल हैव अ ह्यूज प्रॉब्लम। तो अक्रॉस सेक्टर प्लीज अवॉइड डेट। इट्स इस अनसर्टेन सर्कमस्टांसेस में यू डोंट वांट टू एक्सपोज योरसेल्फ टू डेट रिस्क। So pick companies who are near zero debt. That's very, very important. Second, go for industry leaders. Kyunki, why this is important? There will be a lot of consolidation happening in the industry. Because Say we take the example of aviation stocks. Now we are hearing news that Go Air has asked its employees to go on leave without pay. SpiceJet is facing certain cash crunch or might face certain cash crunch. So say if one of the airline stocks goes down the drain, consolidation in the industry will happen and one of the bigger players will stand to gain. So what will happen is that almost in all industries, companies that were relying on debt to keep running their business, some of those companies will go bankrupt because of these uncertainties across industries. And this will give a huge advantage to a low or zero debt company and a market leader to suddenly capture the struggling company's market share. And the market leader will grow disproportionately as compared to its peers. So sticking to market leaders is a very critical thing that all of you should follow across industries, no matter which industry you're looking to invest in. Invest in number one, number two player, or maybe the number three player. So that is very important. Apart from that, I think, so this is slightly a contra view. I genuinely feel that banks are going to do well. With other options drying up, what happened today with the Franklin debt funds, a lot of people will think 100 times now before investing in debt funds. So a lot of money will come to the banks. And we have already seen that a lot of banks are reducing interest rates on their savings account, on their fixed deposits. So banks have a huge, huge surplus of funds, and those funds are now at a never before low cost. So banks are flushed with low cost funds. So definitely banks have a huge advantage. Strong banks, mind you. Again, go for industry leaders, number one, number two, number three players, and the most efficient players. The banks which are not already burdened with high NPAs, banks which have a good capital adequacy ratio and a good CASA ratio, definitely. These banks, not in the short run, not in 1 year or 18 months, because these banks have to wait for the credit demand to wake up to actually benefit, but they'll be set for future growth. They have positioned themselves for future growth. Of course, in the next couple of quarters, their results will not be great, and you might see short-term pain in these banking stocks. But over the long run, this is a nice time to start investing in some great banking stocks, and they are set for good growth. One more thing. So everyone, is already saying that FMCG stocks are safe. Yes, I agree. And the great thing about FMCG stocks is that you're getting them at never before seen valuations. So yes, I mean, FMCG stocks are usually always a buy. And with these kinds of valuation, some good quality FMCG stocks are trading at never before valuations. Very good sector to invest in, goes without saying. One important aspect that you need to keep in mind while creating your portfolio is that focus on India-facing companies. Focus on companies that derive its maximum revenue from India. Because what will happen is that when COVID increases in which part of the world and how much time it takes to decrease will vary hugely by a certain number of factors. So in these uncertain circumstances, you don't want to take global risk. You don't want to invest in a company which derives 30% of its revenue from America, 30% from Europe, 30% from Africa, and things like that. That way, this company, that particular company, will not perform until the entire world is free of COVID. So the time that this kind of a company will require to recover will be much more than, say, an India-facing company. And sitting in India, all of us are in India. It's much easier for us to predict when will this company recover, when is the lockdown going to recover, when are the markets going to open again. We can all see that happening. We can all make calculated predictions. So it's important to stick to India-facing companies, because anyways, even if you pick a global-facing company, you cannot entirely avoid India risk. All of these companies will be affected by what's happening in India. So India risk you cannot avoid. At least avoid global risk right now. So that is another aspect to keep in mind. Lastly, and this is again something very common, look for change in habits, because some habits will change permanently. So, digital consumption, some people are now completely addicted to it. And even when the lockdown opens, it's not that digital consumption will fall drastically. So who are the companies set to benefit from this digital boom? Definitely telecom companies, some OTT players are listed, some content creating companies are listed, Some companies who provide content hosting platforms are listed. Content creation softwares some company provides. Those are again educational company, edutech companies. A lot of such companies are listed, which are set to benefit from this digital boom. Lastly, how to bring this all together and create your portfolio. So, there are some thumb rules. One thumb rule is, if I have to make it very simple for you, how much should you invest in equities? What percentage of your total surplus income should you invest in equities? So a golden thumb rule is that once your EMI payment is sorted, once your basic monthly recurring expenses are sorted, any surplus that you have, taking care of future educational needs of your child and things like that, 100, follow the 100 minus age rule. So if you're 25 years old, 100 minus 25, 75. So 75% of your surplus income should go towards equity, which is true in this case as well. When I say equity, it includes mutual funds and stocks, whichever is the way you prefer, depending on your existing knowledge. But now is the right time, is a great time to actually start following this rule and actually start putting money in the market. So one, keep this thing in mind for sure. Another important thing is that your portfolio, what happens is that you find a lot of bargains in a crash like this, and you tend to pick up stocks left and right. So another thumb rule comes in handy here, that you don't hold more than 25 stocks in your portfolio, because then you're not going to be able to, one, track those stocks, read annual reports, read quarterly reports, stay updated with what's happening with those companies. So 25 is the max I've seen an individual being able to handle and track. So make sure that you don't own more than that stipulated number of stocks in your portfolio. And secondly, what happens is, if you own a lot of stocks, say 30, 40 stocks, even if a couple of stocks do well, their weightage in the portfolio is so less that you don't benefit from your good decision. Even though you chose a great stock and the stock did great, you don't benefit from that. So it's better to not over diversify your portfolio. Secondly, it's important that you don't allocate more than 20% of the money you are investing in stocks and mutual funds in a single sector. So sectoral diversification is also important. It's not that you're finding great value in automobile and you put 40% of your money in automobile stocks. Never expose more than 20% of your allocation to a single sector. That's again something that's very important. One more thing, never allocate more than 7-8% of your total allocation in a single stock. So if you're investing 100 rupees in mutual funds and stocks, make sure you don't invest more than 8 rupees in a single stock. And also make sure that your mutual fund is not too exposed to the stock you're investing in. So sometimes what might happen is that you are putting 8% in HDFC Bank, and you have got a couple of mutual funds which have also invested 8% of their money in HDFC Bank. So without you actually realizing it, your exposure to HDFC Bank is much more than 8%. So make sure that you don't invest more than 8% in a single stock. Apart from that, one simple thing is that do not invest in more than 3 companies in a single sector. So if you're buying pharma stocks, make sure that you don't invest in 4, 5, 6 pharma stocks. Pick a couple of stocks, a couple from each sector is usually the way to go. But at most, if you're really bullish on that sector, don't invest in more than 3 stocks. Because if you're investing in more than 3 stocks, you might as well go with the index fund and stop all that headache. So, it's important that you don't invest in more than 3 stocks. So yeah, that's about it. That's some basic pointers that I wanted to share here, and I would love to take your questions now. I might have missed certain things. You might have certain questions. I would love to answer those questions now. Over to you, Anga.
Thank you so much, Pranjal. That was indeed insightful, and I have received a lot of questions. What we shall be doing is that I shall be taking you over through a gist of all these questions. So we cover maximum ones. So a lot of people are asking in terms of when creating an equity portfolio. Could you just highlight a little on the importance of a PE ratio and a PB ratio, book value? How does it impact majorly?
Right. Great question, and I'll require a large chunk of time to answer that because it's not a straightforward answer to that question. Now, the important part here is that what kind of sectors you're exposing yourself to. Because what valuation parameters are you looking at completely depends on the sectors you're exposing yourself to. Say if you have 20% allocation to the financial sector, then PB ratio becomes very, very important. You have to check what price to book they are trading at. So when it's a banking stock, PB ratio becomes one of the most important valuation metrics. And similarly, it differs from sector to sector. Say if it's an FMCG stock, you might look at free cash flow generation and then price to free cash flow. You might look at P ratio as well. So, this will greatly differ from the kind of stocks you're looking at. But yes, having said that, regardless of the valuation techniques, one thing we all have learned from this crash is that you cannot ignore valuations. What was happening was in the last couple of years, we as an industry in general were ignoring valuations in favor of quality. We thought that if the company has quality, all valuations are justified because that company has capital allocation skills. And if capital allocation skills are good in a country like India, where consumption can grow on for the foreseeable future for the next 10, 20 years, we don't need to worry about valuations because the company, if they know to build, to allocate capital, they'll continue to grow for 10, 15, 20 years. So we used to ignore valuations. So depending on the industry, valuation metrics will change. But of course, please do not ignore valuations because, if you buy a really expensive stock and a crash like this happens, the fall can be disproportionately more. So looking at P, I would say this is the most commonly used metric, is not always the right thing to do because PE can be really, really misleading for a simple reason is that, say, take an example of a real estate stock. Now, what happens with real estate companies is that earnings come in chunks. Earnings are not very regular. You cannot have, say, earnings stability like HUL, wherein every quarter the earnings grow by 2 to 4%. In real estate, what happens is once a new project opens for booking, suddenly there is a lot of sales. Suddenly you will find a lot of earnings happening, a lot of bookings happening. And then for the next year, if no new project launches, you find that revenues have dried up. So if you look at PE for such a company, at times the PE will look very high when the earnings are low, when the bookings are not happening, and you would find that this stock is very expensive. Whereas on the other hand, when suddenly bookings have opened in the last quarter, a lot of sales happened, and the company's accounting policy is such that it has recognized most of the revenue in this quarter, you would find that the PE is very low because earnings have suddenly increased. So, the denominator has changed substantially, and you would find that the stock is cheap. I should be going for this stock. Whereas, because the company has just booked earnings, it might happen that the company has no new product launch lined up for the next 2 years. And for the next 2 years, you would find regretting your decision because the earnings refuse to go up from that large base. So relying on PE can be very, very misleading. Cash flows are a better way for most of the companies. So if I have to give you a thumb rule, whether to rely on profit and loss statement or cash flow has to get priority for most of the companies, and thereby free cash flow and DCF is much, much more important for most of the companies.
Well, I think, thank you so much. I think the thumb rules are really something we are going to keep into account. Now, a lot of people are really asking, they want to get a sense of what is happening with crude oil. How is the situation like? People are trying to grapple the situation. So could you throw some light on it, that what is happening with the sector? How should you move forward with it?
Right. So again, in general, if I talk India specific, India is an oil importing country. So whenever the crude oil price goes down, in general, it's a positive for all oil importing countries. But again, Indian government sets to benefit from it when consumption happens. There's no benefit of buying something cheaper when there's no use of it. So right now, oil demand is at a multi-decade low. So no matter how much the price falls, India is not practically in a position to benefit from it, especially with India's low storage capacity. So it's not that India can buy a lot of oil at low prices and then store it. India's oil storage capacity is very, very low. So economy-wise, although falling prices in theory are very good for India, but government is not going to get much revenue from that because the negative consumption compensates for lower price. Having said that, second thing, should you invest in upstream or downstream oil companies? Right now with such great sectors, FMCG, pharma, IT, banking, automobile, even I find automobile sector to be a great opportunity due to the valuations they are at. So, I don't see why you would go towards allocating your precious capital in these upstream and downstream oil companies, which always face a lot of uncertainty, global price uncertainty, as well as a lot of government action uncertainty. You never know when the government will change its policies around these companies, when will it allow free pricing, when will it impose a pricing cap, and a lot of other uncertainties. So basically, the performance of these companies are not dependent on their management. To a large extent, the performance of these companies are dependent on the government and on the world prices. So it's like, so either you are an extremely brilliant person, you have the exposure and experience of how pricing works, how market dynamics work in the oil and petroleum industry, then yes, you should take an exposure. But for a general common person who knows about average and nothing above average about this industry, I don't see why you should take exposure in upstream or downstream oil companies, especially when all other sectors are available. And even I found certain theories around that by companies for which oil is the raw material. So paint companies, a lot of chemical companies. But again, the question arises: will Asian Paints sustain the kind of growth it has sustained in the last few years this year? Will people, paint their houses as much as they used to do before? So that's the question. And in general, Asian Paints and a lot of paint stocks are always a good buy. So just because crude has fallen a lot, I don't see that's a reason to take exposure, particularly to this sector, especially when other sectors are at brilliant valuations. I would suggest stay away from the sector.
Okay, I think that was really something everybody needed to hear. There is a very interesting question where, the person is asking that whenever a correction occurs,
Right.
the money gets discounted. So should they withdraw money whenever there's a bubble or a global concern issue, or should they stay put? आई थिंक दिस इज अ कंसर्न. ये बहुत सारे इन्वेस्टर्स को भी ये कंसर्न होता है कि क्या उन्हें दे शुड स्टे पुट या उन्हें पैसा निकालना चाहिए जब ऐसा कुछ होता है मार्केट्स में.
Right. So again, I mean, see, honestly, no one has been able to time the market perfectly because, honestly saying, was there a bubble in India before COVID happened? Was there a market-wide bubble? Definitely no. Small caps, mid caps were trading at 2 years low, 3 years low, and things like that. So there was a bubble in certain large caps and in certain consumption and quality stocks. But was there an overall bubble? No. I mean, if this wouldn't have happened, small caps and mid caps were trading at very, very reasonable valuations and were set for growth. So if there is a bubble and if there is a consensus that there is a bubble and the market is going to fall, by the time you know that, it's already late because by then the smart players will already start withdrawing money and the market will already start, correcting. So firstly, there was not a market-wide bubble. And secondly, no one is able to time that perfectly. You can find out certain pockets which are expensive. You can find out that, okay, pharma stocks are getting expensive. I should get out of this. Maybe this sector is going way too ahead of its valuation. I should move out of this. But in general, you don't want to predict this because what happens is that, so, I don't remember the exact numbers, but there was this certain data that in the last 30 years, if you would have just missed 35 days when maximum up move happened in the market. So, there are certain days in the market when market moves up 5%, 6%, 7%, 4% in a single day. So if we collect just 37 of those days in the last 30 years, and you were not present in those 37 days in the market, you would have literally made less returns than savings account despite staying in the market for 30 or more years. So, it's very important that you are in the market always so that you don't miss such bonus days, which happens probably once or twice in a year. So, if you think that market at 40,000 is expensive and I should go out of the market might as well go to 45,000, 50,000 within a month. And you lose out on potentially earning 20%, 25% more. Because you might know that the market is expensive, but that doesn't mean that the market will fall from here. It might as well get 30%, 40% more expensive and then start correcting. So do you want to lose out on those 25, 30, 40% gains? I'm not too sure. So, what's a better strategy is that if you are this sort of investor, like I am always fully invested. I believe strongly in equities. We have all seen how in the last 30, 35 years, equities have been the best performing asset class. So I am almost always fully invested. But if this thing being fully invested gives you sleepless nights, the best thing to do is that always be 70% invested. So if you have 100 rupees to invest in the market, invest only 70 rupees, 75 rupees, and keep the rest as buffer that whenever the market falls, I'll invest this money again and average out my holdings. So that will give you a sense of comfort. But I don't think that whenever you think the markets are expensive, you should move out, because just being expensive doesn't mean they cannot be more expensive. So don't miss out on potential earnings.
Thank you so much. I have received a question. The person is asking, what are your views on insurance companies, since you covered the financial sector briefly, and life insurance and non-life insurance, and are these good avenues for investment at this time?
Right. So now anything that deals with medical insurance, say life insurance and health insurance, I've always liked them, not because of COVID, but I generally like them and I continue to like them. And yes, if you find certain companies, decent valuations, good reputation in the market, sales growth, yes, health insurance, medical insurance, good bets. General insurance, I'm not too sure. I mean, there's a lot of discretionary insurance that used to happen. Say we all used to, whenever we booked these hotels, flights on the digital apps, we found this option of travel insurance just for a few bucks. I don't think, so those insurance are going to suffer. With no travel happening, travel insurance is going to suffer. A lot of white goods insurance, a lot of fire insurance, home insurance, laptop insurance, phone insurance, that is going to suffer for a few months or even a year. But health insurance, life insurance, definitely. I mean, as more and more Indians become financially literate, a lot of Indians right now skip on insurance. India's GDP to insurance premium ratio is one of the lowest in the world. So as India develops, as Indian population matures, gains more financial literacy, I mean, regardless of short-term good things happening, bad things happening, in general, next 10 years, health insurance, life insurance companies, definitely that sector and good companies are set to grow. So yes, those will be good compounding machines.
Thank you so much. The next question is quite interesting, actually. Do you recommend investing in large cap or good stocks, say, directly in equity, or can somebody choose to opt for SIPs in mutual funds of these large cap companies? Like, how can we weigh this?
Right. So, firstly, I'll deal with the sector part, whether you should invest in large caps, mid caps, and then we'll move on to whether you should invest directly in stocks or mutual funds. So, whether you should invest in large caps, mid caps, or small caps, not really material. First, there are two golden rules that I mentioned. First, the company shouldn't have any or very less leverage. A large cap company hugely leveraged is worse than a small cap company that is lightly leveraged. So leverage is important, degree of leverage. And secondly, whether that company is an industry leader or not. There could be a large industry and even a large cap player could not be the industry leader, like cement industry, steel industry. These are big industries. And companies with market caps of 20,000 crores, 5,000 crores, 10,000 crores are not market leaders. Banks, very big industry. Even a bank with a market cap of 10,000 crores, 20,000 crores is nowhere the market leader. Whereas there are some industries in which even a 2,000 crore market cap company is the industry leader. So picking out companies with no leverage and selecting industry leaders, it could be a big fish in a small pond. That's completely fine. But being the big fish being in a position to be able to eat the smaller fish in these uncertain times is the more critical thing. Moving on to the second part of the question, whether direct stocks, whether mutual funds, see, depends on your comfort level. But again, I'm assuming that if a person is asking this question, he should go with mutual fund because then he or she is not very comfortable about his or her own stock picking skills. So if that's the case, if you are new to the market or if you don't want to invest substantial time in researching about stocks, see, the worst thing you could do in the stock market is investing on the basis of advice of your friend, your next door neighbor, or your barber. So, do not invest on the basis of what your barber tells you to do. So that's the worst you could do. If you think you do that, if you invest blindly on the basis of what your neighbors suggest you, you're better off going with mutual funds. But if you think no, I like researching. So if you're passionate about the stock market for you is not just an avenue that gives you a few percentage points more of return than say FD, but it's much more. You're passionate about understanding industries. You want to know how the economy works. You're passionate about fiscal policy, RBI measures. Basically, if you're interested in finance and economics, and you think of equities as a genuine way to create disproportionate wealth and not just wealth in line with the market returns, then yes, you should go with equities, but it has a prerequisite requirement that you understand equities. You understand, even if you're going through an advisor, even if you take an advisor, it's important that you don't trust your advisor blindly. You should at least have the basic knowledge to be able to identify whether your advisor is committing blunders or not. The final decision might be left to your advisor, but there has to be basic understanding wherein you can identify conflict of interest or absolute stupidity on part of your advisor. That amount of financial knowledge is a must if you are looking to invest directly in equities. Otherwise, if you want to live a relaxed life and let experts do their work and while you relax and take benefit of the market returns, mutual fund is the way to go.
Thank you so much. Now I have another question where you said that you find the auto sector very promising.
Right.
Could you just take us through why so, and what is your view on the sector for the coming 6 months?
Coming 6 months, absolutely bad. I mean, for the short term, that sector is definitely not going to do well. But having said that, I feel everyone realizes that, and thereby markets have realized that and already discounted that. Not just next 6 months, I believe market has discounted next 1 year. And if you look at most of these automobile companies and who are they backed by, say the Mahindras, the Tatas, the Sundarams, Bajaj Group, these are firstly known for their good corporate governance, known for their good capital allocation, known for their ethics. You don't expect suddenly a fraud coming out of a Mahindra Group, Tata, Sundaram, or Bajaj groups like these. So fortunately in India, most of these groups that operate in the automobile sector, firstly, especially these four companies, it's not going to happen that because of the slowdown in auto sector, these companies are going to go bankrupt. This is not going to happen. And in such times, this is a huge relief. These are giants of Indian industry and they will keep those companies afloat. And all these companies are known to keep investor first. Very, very investor first and ethical companies. So that's one comfort. That tells me that, okay, these companies, it might take not a year, but a couple of years or 3 years to give me the kind of returns I expect. But blunders are not going to happen in this industry. That's one. Second, absolutely mouth-tempting valuations. Very, very attractive valuations. So, if you can bear the pain in the next 6 months, 9 months, 1 year, you're not looking for short-term gains. That's not going to happen in the automobile sector, sure. Second, if you enter today, you could see that these stocks fall 20%, 25%, even 30% more from here. So you should have the mental ability to make peace with these stocks going down 30% more. You shouldn't panic. If you have these two qualities, I think automobile provides a great opportunity. Having said that, if you have say 100 rupees to invest in this sector, it's important to invest in an SIP fashion wherein for the next 4 months you invest 25 rupees each month in these sectors, because the next 4 to 6 months can be really volatile for this sector.
I now move on to the next question. There are several, doubts people have regarding asset management, especially after, the Franklin incident. And, they are asking, you briefly touched upon debt funds, on whether they should still include debt funds in their portfolio, and asset management companies. Like, how do you look at both of them?
Great question. I mean, Anga, if you remember, before the start of the webinar, we were just discussing on this. See, honestly, I have never understood. So even in our advisory, we never recommend debt funds. Even in my YouTube videos, I never talk about debt funds except a couple of very safe liquid funds and overnight funds. In general, the category of debt funds and the category of balanced or hybrid funds, I really don't like. A couple of reasons, even see, what happens with equity and debt, the fundamental difference between these two categories is that risk and returns are almost always proportional in the debt side. Whereas, if you want the best returns from the equity side, it's not important that you choose the riskiest micro cap or the riskiest small cap. At times, a lot of times actually, blue chip, low risk stocks also give better returns than the riskiest of small caps or micro caps. So on debt side, there's hardly any risk reward arbitrage. On the equity side, there's a lot of risk reward arbitrage available due to market inefficiencies. So you need to realize that firstly, what retail investors do is, they track historical returns of a stock, and then on that basis, sometimes they select a stock. When we, take that habit to the debt side, it becomes extremely dangerous, because almost always this will be the case that if a debt fund is giving higher returns in that particular category, and based on the returns of that particular fund, we invest in that fund, 90% the case has been that the fund has invested in lower quality instruments and has taken higher risk than required, which is not always true for equity mutual funds. An equity mutual fund with lower risk can potentially generate higher returns. But in debt, it's very, very next to impossible. So for a retail investor, our minds are tuned in a way wherein if we are selecting a fund, we check historical returns. So when I select a liquid fund, which is the only category I think is okay at times, not even all the time, the first thing I would look is probably lower returns. But how many of us pick debt funds on the basis of lower returns? Mostly none of us. So that's one reason why liquid funds are dangerous. Higher the return, higher the risk. Secondly, why would you need a debt fund? See, usually a debt fund would give you roughly 2 percentage points more than what an FD would offer. So instead of 6.5%, 7%, you're getting 8.5%. Now, is taking credit risk really worth it for 1.5%, 2% higher returns? I mean, if you really need to go for higher returns, if you're really craving for higher returns, invest a smaller amount than you would in a debt fund. Say if you are looking to invest 40 rupees in a debt fund, invest only 20 rupees in an equity fund and keep the remaining in FD, so that that capital is absolutely safe, the 80 rupees. And on the 20 rupees, firstly, the invested amount is half, so your risk is half. And now, if the equity fund performs, you will not defeat FD returns by a percentage point or two. You will defeat it by 6, 7, 8 percentage points. So, the risk reward ratio, I don't get, how that is viable in a debt fund. Mostly debt funds are an avoid. It's better to, just decide clearly which is the money you want to put, invest in a risky instrument, take risk on to generate alpha, invest that in equities, and what is the amount you want to keep absolutely safe, invest that in FD. And it just lessens the complication, because ultimately a financial plan has to be very, very simple in order to work. And this clear segregation, I believe, is a huge simplicity that generates alpha.
Thank you, Pranjal. I will just mention it to our audience that we will now be taking in the last questions. So with that, I have a question. Would you still suggest a diversified portfolio in this market scenario? And if yes, could you give us what should an ideal diversified portfolio look like?
I mean, interesting question, but there cannot be a blanket answer for that because while I told you that your exposure to a certain sector should not be more than 20% and exposure to a certain stock should not be 8%. Now, which sector should you expose yourself to the limit of 15% or 20%, and which sector's exposure you should cut down on really varies every quarter depending on the valuations available. So, a better approach, and this is what we do at Finology, is to identify certain sectors which are a strict no-go, either because they don't have enough listed players, either because you don't understand the sector. You have to be humble enough to recognize that okay, this sector is out of our competence, we don't understand this sector. So no matter how much if you so a lot of I see a lot of retail investors investing in pharma stocks, but they need to ask themselves, do they have the required knowledge about the pharma sector to differentiate between the business model of say Lupin versus Cipla? How are these two companies fundamentally different? Both are pharma stocks, but they could be as different as say Americo and Britannia. One is mostly into food and one is mostly into hair oil. Now these two categories are not same. So we are able to identify that in FMCG stocks because we understand what these companies actually do within the FMCG basket. But pharma and IT are two sectors wherein I find that people are not able to distinguish between business models. So a Biocon or a Syngene is completely different from a Sun Pharma or a Lupin. Completely different. Similarly, say revenues, sectors from which HCL Technology or Tech Mahindra derives revenue is completely different from what an Infosys or a TCS does. So the naming is same, IT, but otherwise these companies are different. So the point here being whether you genuinely understand that sector. So someone can definitely take 20% exposure to pharma sector if he has been, maybe in his family someone is a doctor or he's a chemist or someone is in the pharma sales side and he knows that. Whereas someone who belongs from the banking background should take 20% exposure to the banking sector. So it really depends on your circle of competence. Having said that, there are some sectors I don't like and I would like to avoid. For example, in general, aviation we don't like. Indigo is an exception. Sometimes we are tempted, but overall, globally, if you look at the sector aviation, most of the airlines remain in losses and they incur losses year after year. So mostly for us, aviation sector is a no. And now with these times, I don't think anyone should look at that sector. Right now, anything that has to do with travel, has to do with hospitality, again, a strict no till clarity emerges. NBFCs, most of the NBFCs, there are 2-3 good NBFCs, and mind you, if you identify good NBFCs, those NBFCs will gain disproportionately because a lot of NBFCs will now not get capital to grow. So certain NBFCs which will get capital to grow will benefit disproportionately. But in general, NBFCs is again a sector which is a strict no. Again, oil, upstream, downstream oil companies, I don't like. I think there are too many external factors on which these companies are dependent. So I cannot pinpoint which is a better management. I can clearly see the difference between the quality of the management between, say, Prestige and Hawkins. You clearly see the numbers, the track record, and you can identify which is a better company. But in terms of HPCL or BPCL or Indian Oil, which is a better one, hard to say. A lot of that depends on the government measures. So so again, I mean, avoid not just sectors but companies in which their existence depends on a lot of external factors. Government mercy, bailouts, you never know whether that's going to happen or not, and if it's going to happen, to what extent. Ask yourself that even if the coronavirus pandemic continues for the next 3 months, next couple of quarters globally, the company that you're looking to invest, does that company have enough reserves, enough cash, to be able to sustain zero revenues. But I don't think there should be a clear answer that which sectors in what percentage should be there in your portfolio. Apart from these 3-4 sectors, almost in each of these sectors you'll find great value. Depends on which stock you like and at what valuation these companies are at.
So with that, I think we move to the last sector. You mentioned which sectors don't work. I mean, you don't like them.
Right.
But which according to you are the 3 sectors which are set to emerge in the next 5 years? So here we are like, we're forward looking and in that sense.
Right. Right. I mean, first a disclaimer: we are very bottom-up stock pickers. So we are not very sector specific, or we don't like to start researching about which stocks to pick from deciding zeroing on a sector that yes, this is the sector, now have to pick 2 stocks from this sector. We don't work that way. But having said that, one clear trend which is very obvious is that companies set to benefit from this digital revolution. Some habits are definitely going to change for better, especially in the Indian metro cities, which are commercial oriented, and you realize the kind of traffic jams, the kind of working hours your workforce has been wasting in transporting from point A to point B. Companies have realized that work, and even in our company, you realize that most of the corporations were a bit jittery and nervous about allowing your employees to work from home because they have had no idea how it would work. Most of these companies had never worked that way. Now that they have got a chance to experience that, I'm sure a lot of companies are going to switch to work from home. So that is again a clear sign wherein which companies are going to benefit if this work from home culture gets even 5% traction. Say any company that builds business tools, or any company that builds consumption either platforms, or companies that help in scaling or building those consumption platforms. A lot of people have got addicted to an online, be it games, be it online OTT apps, be it video conferencing apps. Any company that is set to benefit from this online consumption boom, and mind you, there are a lot of companies. If you actually look in depth, there are a lot of such companies listed in the Indian market which are going to benefit from this boom. So one, this is a clear sign this is going to happen. Secondly, somehow this is a bit of a long shot, but I genuinely feel that staying at home for months on a stretch have made people realize value of their homes. So I somehow feel that if the population is working from home, they would want to take speedier decisions about buying their own home. If they realize that okay, my company has decided that we are going to work from home, I am spending 24 hours at home, and this is going to be the way it is. Why not get myself a better home? Of course, not in the next 3 months, 6 months, because everyone is wondering about pay cuts and job losses. But in the long run, a lot of people will think about, since more and more people are now living in home, even during weekdays and daytime, you naturally need bigger space if more members are living during working hours at home. So I see a lot of scope for residential properties as well. And again, real estate is a sector wherein, like automobile, there is a lot of value. Stock selection is tough, mind you. In automobile, I told you that most of the companies are backed by great promoters. So you don't need to really worry about bankruptcy or anything going bad. Real estate, stock selection becomes very, very important. Generally a risky sector. You have to pick a company that is, one, focused on residential projects, and second, is very, very lean and has almost no debt on its books. So this is, again, I see a clear beneficiary wherein residential real estate properties are set to benefit. And again, I mean, what's great with this market is that while there's a chase behind pharma stocks, somehow, because in India we don't have a direct listed player in the online consumption space like Netflix or like say Amazon Prime, where you just find okay, Netflix is listed in India, I'll go and buy. There are hardly any companies which are direct beneficiaries of online consumption, but there are a lot of companies which are indirect beneficiaries of this. So I think this is a clear sign. This is going to happen. Secondly, somehow this is online consumption. And the market, the retail investors have not yet started to blindly run behind them. So those stocks still have a lot of value. And if people research, they'll find a lot of good opportunities in companies set to benefit from online consumption.
Thank you so much, Pranjal. It was an immense pleasure to have you on board and on our platform. And your thoughts and insights on the current landscape, the sectors, I believe was extremely useful. The session was very engaging, and I'm sure that the audience found your expertise of significant value and they'll gain a lot from this. Thank you so much.
Honored.
And thank you so much to our audience. Thank you for tuning in. We look forward to having all of you join us back again next Wednesday for our next webinar. Till then, from Pranjal and from all of us, stay at home, stay safe, and stay calm.
Bye-bye. Thank you.
Thank you.